Hello and welcome back to another episode of Investia Global. My name is David, and in this video we're going to go in depth on risk management and money management techniques. Just as one of the best commodity trader in history, Ed Sikota, said, the most important rule of trading is to keep your losses small and let your wins run. Effective money management is key to success. Here's a list of the things we're going to cover on this episode. 1. Introduction to money management and risk management. 2. Money management. 3. Risk management. 4. Psychological aspects. So let's get right into it. On introduction, we'll learn basic understanding of account finance management. On money management, we'll learn key principles of money management. Then on risk management, we'll learn identifying and managing risk. And finally, on psychological aspects, we'll learn discipline and emotional control. Let's start with money management. First, we'll learn our risk per trade, which is simply the percentage of your trading capital that you are willing to risk on a single trade. We highly recommend you should risk no more than 1 to 2% of your total trading capital on any single trade. This ensures that even a series of losses won't severely impact your overall capital. Secondly, let's learn position sizing, which determining the amount of money to risk on each trade based on your stop loss and overall risk tolerance. Here's how to calculate your position size. Position size equals account equity times risk per trade divided by stop loss in pips times pip value. Third, let's see how to diversify our investments, which is simply spreading your investments across various currency pairs to reduce risk. We highly advise you to avoid concentrating too much capital in a single trade or currency pair. Diversify across multiple pairs and strategies. Next, let's see how to use leverage, which will allow you to control a large position with a relatively small amount of capital. Note, use leverage cautiously. High leverage increases the potential for large gains, but also magnifies potential losses. Stick to a leverage ratio that aligns with your risk tolerance and trading strategy. Lastly, let's talk about a trading plan, which is a comprehensive plan outlining your trading strategy, including entry and exit rules, risk management, and money management. We highly advise all traders to develop and follow a well-defined trading plan to ensure consistency and discipline in your trading approach. Now let's move on to risk management, where we'll discuss 1. Risk to reward ratio, which is the ratio between the potential profit of a trade and the potential loss. We advise you to aim for a risk to reward ratio of at least 1:2 or 1:3. For example, if you risk 50 pips on a trade, target a profit of 100 to 150 pips. 2. Maximum drawdown, which is the largest percentage drop in your trading account equity from its peak. We highly advise you to set a maximum drawdown limit to prevent excessive losses and protect your capital. Cease trading if you reach this limit to reassess your strategy. 3. Position correlation, which is the degree to which two currency pairs move in relation to each other. We advise you to avoid taking multiple positions that are highly correlated. This can increase risk exposure if the correlated pairs move in the same direction. 4. Placing a stop loss, which is an order placed to automatically close a position at a predetermined price to limit losses. We highly advise you to always use stop loss orders to limit your exposure and prevent significant losses. And 5. Regular monitoring and review, which is the continuous evaluation of your trades and strategies. We advise you to regularly review your trading performance, including wins and losses, to identify patterns and areas for improvement. Adjust your risk management strategies based on your findings. And finally, let's discuss some psychological aspects. Firstly, avoid overtrading. Stick to your trading plan and avoid impulsive trades based on emotions or market noise. Secondly, practice emotional resilience. Develop mental discipline to manage stress and avoid emotional decision-making. Stick to your risk management rules even after experiencing losses. Lastly, set realistic goals. Set realistic profit targets and risk levels based on your trading experience and market conditions. Avoid aiming for unrealistic gains that may lead to excessive risk-taking. And that's all we have for you today. Don't forget to like, subscribe, and leave us a comment on the topics you want us to cover next. My name is David, and I'll see you on the next one.